Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Jeffrey Dennis, independent emerging markets commentator, joining in. Welcome to the show, Jeff, and always a pleasure to speak to you and get insights from you. Jeff, the crucial meeting that everyone is awaiting right now is the FOMC. A lot of volatility that we are seeing with regards to where emerging markets as well as developed markets are concerned. And similarly, the same is being translated into commodities as well. What's the sense that you pick up, and what's your view?
Well, I don't think this meeting that's coming up this week is going to be the key feature. It is going to be key in terms of policy changes. I think what they're going to do with this meeting is to set the stage for the end of QE in March, presumably, and possibly the first interest rate increase in March as well. So I think what you may find is just preparing the ground further for the next policy move. I think the Fed will express some concern about the markets because obviously the markets in the US, especially the tech sector, has been very weak, obviously. But I think with interest rates in the US at 0 and inflation at 7% currently, they won't want to say anything that allows the market to assume that they're not going to start tightening policy significantly as you go through the rest of the year. So I think the kickoff to really tighter policy as opposed to lower QE, i.e. less accommodating policy, the kickoff to tighter policy, I think begins in March. And so this is an interim meeting, which I think is all about probably managing the market's expectations.
Right. So overall, when you're talking about the Fed as well, do you think, is it right to say that a hawkish Fed wouldn't mean doom for resilient emerging markets?
I think that's a very, very complicated question and a great question to answer, to ask. My view is very straightforward. This all depends on the performance of the dollar. And what you've seen, of course, just in the last few days, to be fair, is you've seen the dollar strengthening up again, and you've actually seen some of the emerging markets begin to pull back once again, although obviously it's been a much, much better year for emerging markets so far this year than for developed markets. Now, we've had, I think it's 4 Fed tightening periods over the last, Fed tightening phases over the last 30 years when emerging markets have been a live asset class. And they don't always lead to difficult performances for emerging markets. The one that's particularly notable is the Fed tightened steadily from mid-04 to mid-06. And the emerging markets kept moving strongly higher, very, very strongly higher, 30% per annum in dollar terms. The reason for that is twofold. Number one is you had a lower dollar over that period of time. And secondly, of course, this was the boom period of commodity prices, the super cycle, and of the opening up of China and, of course, of India. Now, my sense is that my base case is that the dollar's going to stay probably relatively firm. I say that with some hesitation because I think it's overvalued, and I have a long thought the dollar should correct. But if the Fed really is going to do a lot of work this year in terms of tightening and into 2023 as well, I think the dollar stays relatively firm. And I think that's going to limit the upside in terms of emerging markets. And if I could just say one other thing about this, is that you've got to look at China differently. China was a huge drag on EM in 2021. In fact, if you took China out of EM and you took the US out of DM, they were not far apart, the two asset classes, about 300 basis points, about 3%. We're getting the reverse of that this year. China's outperforming, the US is underperforming. China's currency will be fine because of their huge trade surplus. So depending on how strongly China does here, and I think it will rebound in 2022, that will obviously drive, to a certain extent, the emerging market index. But outside of China, I think a lot will depend on what the dollar does. And I happen to think the dollar will stay strong. And therefore, I think it's going to put markets like Turkey, Russia's already down a lot. South Africa, Brazil, to a certain extent, maybe even India. A lot of these perceived, India's not a weaker credit, but some of the weaker markets under some pressure. The dollar's the key thing here. It's not really the Fed tightening as far as emerging markets are concerned.
So how many hikes are you expecting in 2022?
I think it's going to be 3 or 4. I think probably more likely 4 than 3 if I can pass that. What I think is very difficult to analyze is where we go beyond that, because obviously when you get a big sell-off like you've had in the last few days, which by the way is all about high inflation, truly massive change in the market's view about what the Fed policy is going to be in 2022, and some rise in yields. When you get the market sell-off because of that, and valuations, of course, are being brought down because of this sell-off, if it goes a lot further, the Fed's going to worry about the impact of that on the overall economy. So frankly, all of those people who are saying 7 rate hikes in 2022, another 3 or 4 in 2023, I'm not prepared to go that far. It depends how the market absorbs this. So at the moment, my best guess is that the Fed will raise rates 3 to 4 times. That's once a quarter, probably about 25 basis points. And then we'll raise rates again in 2023. But a lot of that will depend on what the bond market does and what the economy does. Of course, the US economy and the global economy will be slower in 2022 because you're losing some fiscal stimulus, and especially in Q1, because of the Omicron variant. So it's going to make it very, very challenging for the Fed to manage this. So for me, the thing to do here is to have a middle road sort of view, i.e. 3 to 4 rate hikes this year.
Right. So with that, the moment Fed hikes interest rates, it's not only that the borrowing costs go up in the US, but even throughout the world, especially the countries which have a higher dollarized debt as well. How do you see that impacting emerging markets as well? Because these are the ones who've actually taken advantage of the decade plus of low interest rates by issuing sovereign bonds denominated in dollars, and that now face the prospect of refinancing those bonds in much less favorable conditions.
Now, we must distinguish, as is implied by your question, we must distinguish between those countries that have put on a lot of debt, but it's nearly all in local currency. And Brazil's a very good example of that. China is another very good example of that, with countries that have put on a lot of debt, most of which is in foreign currency. And Turkey is your prime example of that. So as all this happens, particularly if the dollar stays strong, it's the Turkeys of the world that are most vulnerable, as opposed to, say, Brazil, and certainly compared to China. Now, what we have to bear in mind, of course, is that a lot of these countries have already raised rates last year. Again, Brazil is a great example. Russia is a great example. And that does give some protection in the event that the Fed starts to move. And my call, as I say, is quote unquote only 100 basis points of Fed rate moves in 2022, which is not much compared to what's happened in Brazil and Russia, for example, over the last few months. So how badly that impacts emerging markets going forward, or to the extent it may impact them badly at all, will depend on what the currency responses will be. You've seen the real in Brazil rallying this year, the South African rand, the Indian rupee a little bit, although it's pretty flat, the Indian rupee. The Turkish lira has gone up, but that's going to end, I think, pretty soon eventually. So it depends on how those interest rates play into what's already gone on in terms of monetary policy in these countries, and of course, how the dollar plays out. Now, the biggest upside, if I can just say this additional point, the biggest upside risk to the emerging markets in 2022 is that the dollar finally collapses or falls sharply, let's say 5, 10, 15%, maybe 15%, maybe too much. If that were to be the case, with the interest rate defense that a lot of these countries have got, you will find that the currencies rally sharply. That's going to suck a lot of money into EM. And that's what you're seeing with Latin America so far this year. That's the main beneficiary of that. And then EM will have a very good year. So For me, and I'm sorry, I bang on about this all the time, and I've done so for 20 years plus, is that it's not the Fed tightening that's going to drive EM. I think it's going to be the reaction of the dollar to the Fed tightening. And therefore, I suppose in general, the reaction of financial markets overall, including, of course, the US bond market.
Right. And with this, this is not the only headwind that emerging markets are going to see. Another two aspects that we need to touch upon, Jeff, is the growth in terms of China, which is slowing down. And secondly, the ongoing geopolitical tensions, especially if you have to talk about US-China, US-Iran, and Ukraine-Russia. How big an impact will that be to the emerging markets?
Well, the second one is, of course, dramatically undefinable. We just don't know. And clearly the Russia-Ukrainian situation, which to me as a person interested in geopolitics, but no sort of expert, looks very, very dangerous indeed. And you are seeing that coming out in terms of the Russian market. I'm just checking my numbers here. Russia in dollar terms is down 19% already in January. So it's been a big negative. And that's in the face actually of reasonably strong oil prices. That's a remarkable performance. So that one is going to be front and center for the time being. There's always political tensions around the world, always things that could go wrong. We've also got elections in places like Brazil, in Colombia. We've got a lot of political tensions in South Africa, for example. So I'm not sure I would argue that US-Taiwan, US-Iran is going to make a big difference to emerging markets this year. But obviously, to the extent that those do flare up into something more significant, for example, the Chinese invasion, heaven forbid, of Taiwan, and then there would be a very big negative. And I think what you're seeing a little bit with this dollar strength that you've seen over the last 24, 48 hours, in the face of weaker equity assets in the US, is probably partly the flight to defense that is associated with clearly significant fears that there's going to be some sort of military conflict over the Ukraine. So that's one way that could come out. So if you were to get geopolitical tension spilling over all around the world, with Iran, it would probably mean higher oil prices. EM will suffer from all of that, even if EM itself is isolated from most of this, because it's going to come out as a flight to quality, a flight away from risk, stronger currencies like the dollar, and it's going to put EM under pressure because of that. But predicting when any of these events is going to really kick in is, of course, very difficult. But right now, you really have to worry about the events in Eastern Europe, and that's obvious, I think, to all our listeners.
Right. And very lastly, Jeff, amongst emerging markets, where would you actually place India, and what's your view?
Well, I think the biggest problem India's got right now, frankly, is the superb year you had last year, and therefore the tendency, because you're seeing this across EM, for a sort of contrarian shift. So Latin America is doing very well. Russia's doing very badly. India is down this year. It's not down a lot. China's is an outperformer this year, although it's only up, I think, excuse me, looking at my numbers, it's only up 0.8% in dollar terms. So that makes it a marginal outperformer. So you're getting a bit of a contrarian shift. That's point number one. Point number two, you've seen a fairly flat currency. You've seen a little bit of volatility between the 74 level and the 76 level of rupee to dollar over the last several months, but you're not seeing a weak currency per se. And so to the extent that the inflation story in India, which exists like it does in other countries, eventually starts to subside, if that is the case, although I think it's tough for them to cut interest rates anymore at the moment, then you might see some suggestion of monetary policy easing, but that's going to be down the road. Right now, of course, the issue is going to be the Fed to some extent, and that'll be driven by the currency. So I would argue that the risks to India right now in a highly valued market are going to be that it just did very well and it's become perhaps overbought. Could the currency come under pressure if the dollar stays strong? Could you see pressure on the RBI to increase interest rates? And of course, you've always got the risk in, I say always, but you've typically got the risk in India of a fiscal stance that is frankly too loose. So I think for EM, and I'm a little contrarian on this, and I'm cautious EM this year because of the dollar, because of these US events. I expect China to outperform. I think India will do quite well. I don't think it's going to go up much, but I think it's going to hold its own pretty well. And I don't see it being as weak as some of the other quote unquote vulnerable countries who will suffer in the event that the dollar remains stronger or even goes stronger from here.
Right. So that's the view coming in. Thank you, Jeff, so much for joining us on the show. It's always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thanks very much. Bye-bye now.
Bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.